Hey guys, welcome back to the Bitcoin Fortress podcast, building one block at a time. Today is Sunday, April 5th, 2026, and this is episode 210. We are at block height 943794. Moscow time is 1484, and fees are 1, 1, and 3. And for those of you who celebrate, Happy Easter! This week felt like one of those classic Bitcoin weeks where the surface level price action looked messy, but underneath it, the signal was strong. We saw ETF flows improve, major corporate treasury players keep moving, Bitcoin payments continue spreading into real commerce, and policy developments increasingly point toward Bitcoin becoming harder for institutions and governments to ignore. At the same time, mining economics stayed under pressure, the AI pivot kept accelerating, and the tax and regulatory fights reminded us that not all crypto-friendly policy is necessarily Bitcoin-friendly. So today we will walk through the biggest high-signal stories from the past week. We'll hit the Bitcoin podcast universe, feature our weekly Bitcoin Fortress Substack post, and then we will wrap it up. So with that, let us jump right into the news. First big story this week is that the US spot Bitcoin ETFs brought in about $1.32 billion of net inflows in March, snapping a 4-month run of outflows. That matters because it suggests institutional demand did not disappear during the correction. It merely slowed down and regrouped. For Bitcoiners, the takeaway is that Wall Street is still treating dips as accumulation zones, even if the mainstream narrative keeps flipping between euphoria and panic. When ETF flows stabilize after months of selling, that tells me the bid is still there and the machine is still on. My commentary on that would be this. Bitcoin is increasingly behaving like an asset that gets repriced by large pools of capital in waves. That does not make it less sovereign. It just means the marginal buyer is now often institutional. The old retail-only cycle is gone. Bitcoin is now large enough to be pushed around by macro, pension-adjacent capital, ETF rotations, and treasury allocations. That is bullish long-term, even if it creates a choppier short-term tape. Michael Saylor's strategy did not report a new weekly Bitcoin purchase during the March 23rd to 29 period, apparently ending a 13-week buying streak. Importantly, that does not mean strategy is out of the game. Strategy's own tracker still shows a reserve of a whopping 762,099 Bitcoin, which remains one of the defining facts of this cycle. My read is that this is not a bearish story, it's more of a pacing story. Strategy has already become a kind of institutional Bitcoin flywheel. Even when they pause, the market watches them. That alone tells you how far Bitcoin has come. We've gone from can a public company even do this to what does it mean when the biggest Bitcoin treasury company takes a week off? That is a massive shift in legitimacy and scale. Tokyo listed Metaplanet disclosed that it bought 5,075 Bitcoin in Q1 2026, bringing its total holdings to 40,177 Bitcoin, enough to jump ahead of Mara and become the third largest public corporate Bitcoin holder. That is a major story because it shows the treasury strategy is no longer just an American phenomenon. It is spreading internationally, and in Metaplanet's case, it is explicitly tied to concerns around inflation, fiat weakness, and long-term capital preservation. Have you seen the yen chart lately? This is one of the clear signs that Bitcoin is becoming a global corporate reserve asset, not crypto exposure, not blockchain optionality, not innovation allocation. Actual Bitcoin on the balance sheet. That is the signal. And every time another public company climbs the rankings, it reinforces the idea that serious capital is choosing Bitcoin over cash decay. American Bitcoin, the Trump-linked mining and treasury company, passed 7,000 Bitcoin in holdings, though its shares reportedly remained far below post-IPO highs. That split is interesting. The company has been successful in stacking Bitcoin, but equity investors have been far less enthusiastic about the wrapper around the asset. That is a useful reminder for all of us. Sometimes the cleanest exposure is still the asset itself. Companies can issue stock, dilute, misallocate capital, get repriced by politics, or simply trade badly. Bitcoin does not have management risk. It does not miss earnings. It does not need a quarterly narrative. The asset is the asset. Another notable story this week was the report that BlackRock's IBIT was trading roughly $16 to $18 billion daily, with reports saying that put it in the neighborhood of Binance spot volume and well above Coinbase's. Even if you take those comparisons with some caution, the broader point is unmistakable. Regulated Bitcoin ETF liquidity has become massive. The commentary here is straightforward. Bitcoin is no longer being financialized around the edges. It is being fully integrated into traditional market plumbing. Some Bitcoiners will hate that. Some will celebrate it. I view it as neutral to bullish. Wall Street wrappers do not change the underlying rules of Bitcoin. They simply create more on-ramps for people who still want exposure through familiar rails. Bitcoin spent the week near $67,000 with war headlines and higher oil prices weighing on risk assets. That is not the sort of backdrop that usually produces clean bullish breakouts. Yet Bitcoin continued to trade as a globally watched macro asset instead of collapsing like some of the more speculative parts of the crypto complex. That is worth emphasizing here now because when Bitcoin disappoints moon boys during a bad macro tape, it is often because people have forgotten what mature assets look like. Bitcoin is not a tiny outsider anymore. It is a global liquidity barometer, a policy hedge, a risk asset, a hard money alternative, and increasingly a treasury asset all at once. That is a heavier role, and it comes with a more complex price action. And certainly the sideways chop drives everybody crazy, and so at some point, people will get tired of it. The sellers will be done selling, and the buyers will have already moved in. And oh, by the way, we're halfway through the cycle, 2 years away from the next halving. So, well, folks, it's always darkest before the dawn. I'm just going to leave it there. One of the week's biggest policy stories was the U.S. Labor Department's proposed rule that would create a framework allowing 401k plans to consider alternative assets, including cryptocurrencies, provided fiduciaries satisfy due diligence requirements. The rule includes a safe harbor concept for trustees who properly evaluate performance, liquidity, fees, valuation, and complexity. This is a huge deal because it pushes Bitcoin one layer deeper into the retirement industrial complex. It does not mean every 401k suddenly goes full Bitcoiner, but it does mean the conversation moves from absolutely not to under what conditions. That is how institutional normalization happens, slowly, bureaucratically, and then all at once. Of course, part of that initiative will also allow 401ks to purchase private equity stakes, which feels a lot like dumping bags on retail. So be careful out there. The updated Parity Act draft became a major talking point because it reportedly offered a $200 de minimis exemption for certain stablecoin transactions while leaving Bitcoin out. That rubbed a lot of Bitcoiners the wrong way, and understandably so. If the government says tiny stablecoin transactions should not trigger tax consequences, but tiny Bitcoin payments still do, it is effectively nudging the market towards state-compatible digital dollars instead of neutral digital money. This is exactly the kind of policy fight Bitcoiners need to pay attention to. It's not enough to have pro-crypto lawmakers if the practical effect is to favor compliant dollar tokens over Bitcoin as money. Bitcoin does not need special treatment. It should just not be singled out for worse treatment. This is where the phrase financial repression starts to feel very relevant. More on that later. Pew reported this week that Arizona and Texas are moving ahead with strategic Bitcoin reserve structures. And it noted that Texas lawmakers had already appropriated funds that were deposited into the reserve in Bitcoin, according to the state comptroller's office. Whether people like state reserves or not, this is now clearly a live policy trend rather than a fringe talking point. My take is that state adoption matters less for the direct amount of Bitcoin purchased and more for the precedent it sets. Once a state establishes the legal and political framework for holding Bitcoin, the Overton window shifts. The next state has an easier time, and the one after that. Bitcoin does not need every state to buy, it just needs the idea of holding Bitcoin in public reserves to stop sounding crazy. We are well on our way there. Bloomberg reported that a Bitcoin-backed municipal bond tied to the New Hampshire Business Finance Authority received a BA2 rating from Moody's. That is speculative grade, but it's still notable because this appears to be a first-of-its-kind product combining a municipal-style structure with Bitcoin backing. This is one of those stories that could sound gimmicky on first listen, but it's actually worth watching. Financial engineering always starts at the edge, then if it works, it spreads. The real significance is not whether you personally want to buy this bond, it is that Bitcoin is increasingly being used as collateral, reserve support, and financial infrastructure rather than merely as something people trade on exchanges. This week brought another wave of attention to Square's Bitcoin payments initiative. CoinDesk reported that Square was auto-enabling Bitcoin payments for millions of US businesses, while Square's own product pages show 0% Bitcoin payment processing fees. And the broader block announcement explains that Bitcoin payments on Square use the Lightning Network for near-instant settlement and were expected to reach eligible sellers in 2026. This is the kind of story Bitcoiners have been waiting for. Not another exchange listing, not another tokenized gimmick, actual merchant acceptance infrastructure from a real payments company. If Bitcoin is ever going to reassert itself as money and not just an asset, this is what it will look like. Boring point-of-sale integrations, fast settlement, and lower friction merchant adoption. Cash App's official terms show a $1 million in Bitcoin promotional campaign running from April 6th through April 10th. On its own, that may sound like a marketing fluff, but it's still interesting because it revives the old school idea of Bitcoin distribution as onboarding. My take, distribution still matters. The more people who touch Bitcoin directly, the better. We can debate whether giveaways attract tourists or future believers, but it's still healthier for Bitcoin to be put in people's hands than for the conversation to revolve entirely around ETFs, leverage, and paper exposure. Real users matter. Owners matter. Self-custody matters. Riot reported that in Q1 2026, it produced 1,473 Bitcoin, held 15,680 Bitcoin, sold 3,778 Bitcoin for $289.5 million in net proceeds, and increased deployed hash rate to 42.5 exahash per second. That is a revealing combination. Operational scale is still growing, but miners are also selling meaningful amounts of Bitcoin to fund operations and strategy. This is the post-halving mining reality in a nutshell. Public miners are no longer pure hodl everything stories. Many of them are turning into capital allocators, juggling power costs, debt, AI opportunities, treasury management, and investor expectations. That does not mean mining is broken. It means the easy era is over. Strong operators survive, weak ones adapt or get absorbed. CoinDesk and other reports highlighted that Bitcoin's network hash rate registered its first quarterly drop in roughly 6 years, with the shift tied to weak mining economics and a broader pivot by some miners toward AI infrastructure hosting. Oil above $100 and energy disruptions added more pressure to mining margins. This is a fascinating development. For years, critics argued miners would never have other productive uses for their infrastructure. Now, AI is emerging as a direct competitor for capital and power. I don't see that as bearish for Bitcoin long term. Bitcoin is anti-fragile. If marginal miners leave, difficulty adjusts, stronger operators survive, and the network rebalances. That is exactly what happened. And who knows, maybe you'll hit a block on your little home mining rig. You never know. Related to that, reports around the March 21st difficulty adjustment showed a 7.76% decline to 133.79 trillion at block height 941472, one of the largest downward moves of the year. CoinDesk also reported miners were losing roughly $19,000 per Bitcoin produced at then current conditions, with average production cost around $88,000 per coin. Bitcoin mining is brutally self-correcting. When conditions get ugly, the network does not need a bailout committee or a central planner. It just adjusts. Difficulty comes down, inefficient operators get squeezed, and the system keeps producing blocks. This is one of Bitcoin's most beautiful properties. Stress is not an exception. Stress is part of the design. This week also saw renewed attention on Bitcoin's post-quantum defenses. Indeed, I even wrote a couple of posts in my blog about that this week. TFTC highlighted developer work around shrimps, describing it as a quantum-resistant signature approach with about 2.5 kilobyte signatures, and framed the broader point well. Bitcoin developers have not been asleep at the wheel. They have already been thinking about migration paths and defensive tooling. This is important because the anti-Bitcoin narrative usually goes like this. Some new technical threat emerges, therefore Bitcoin is doomed. But the real story is usually the opposite. Bitcoin has a conservative development culture precisely because it plans for long time horizons. Post-quantum migration is not trivial, but the key point for all of us is that the people doing serious work on Bitcoin have been preparing, and that is exactly what you want from the monetary network meant to last. And if you want to dig into that a little bit more, check out the blog. I have a couple posts on this. First one about the article that sort of prompted a lot of press this week, this Google study, and then what are people doing about it? Let's jump in now to the podcast universe. The big theme I heard across the Bitcoin podcast universe this week was Bitcoin maturing in multiple directions at once, as macro hedge, as technical project, as self-custody responsibility, and as a real-world payments network. On Coin Stories, Natalie Brunell had Jordy Visser. This episode was The Macro Case for Bitcoin Has Never Been Stronger, which I listened to, by the way, and great show. And Jordy Visser is just a really fascinating guy. The more I listen to him, the more interested I become in some of his takes. He's a Wall Street guy, turned Bitcoiner, but he's a very, very smart guy. And the show's news block also focused on gold versus Bitcoin, Morgan Stanley's ETF, and Washington's crypto rulebook. All of this tells me that macro Bitcoin frame is still alive and well. People are trying to understand Bitcoin not as a niche trade, but as a response to debt, currency stress, and institutional positioning. On What Bitcoin Did, Peter McCormick's feed featured The Debt Crisis Is Already Here with Lynn Alden. Didn't listen to that one, but I need to because I just love listening to Lynn Alden. She's super smart and has a very calm and thoughtful approach to Bitcoin, as well as other investing topics. So we'll have to check that one out. But again, this fits perfectly with the broader vibe right now. Bitcoiners are increasingly less interested in short-term candle worship and more interested in the structural why: debt, repression, debasement, and how governments keep kicking the can. And again, these are topics that I have been talking about, writing about, and talking about, I guess, in the podcast over the past several weeks. On the Stefan Livera podcast, 2 episodes stood out: the Physics of Bitcoin with Giovanni, that was SLP 732, and BTC Prague 2026 with Matthias Kuchar, which is SLP 733. One reinforces the long-duration power law adoption curve lens. The other reminds us that Bitcoin culture, sovereignty, politics, and institutionalization are colliding globally, and not just in the United States. That is a rich mix here, and we can talk a lot about price philosophy and geopolitics and how it all sort of ties together. And finally, on BTC Sessions, Bitcoin Boomers, the Joe Kelly episode on scams, security, and self-custody in 2026 was a strong reminder that the next phase of Bitcoin adoption is not just getting people to buy, it is helping them protect what they own. For a growing audience of older Bitcoin holders, inheritance, multi-sig, social engineering defense, and practical self-custody are becoming central topics. And that is one of the most useful real-world themes in Bitcoin right now. So, if I had to summarize the podcast universe in one line this week, I'd say the conversation is shifting from why Bitcoin to how do we live with Bitcoin responsibly, politically, and permanently. Did want to feature this week's Substack post. This week's featured post from Bitcoin Fortress is Bitcoin versus financial repression. And honestly, it fits this week's news cycle perfectly. When you look at the 401k story, the stablecoin tax favoritism story, and the continued push to channel people into improved financial rails, you could see the broader pattern. Bitcoin is not just competing with fiat, it is competing with a financial system that increasingly wants visibility, control, permissioning, and soft coercion built into every layer. Bitcoin stands apart from that. It gives people an exit, and that is why it matters. As always, if you want to go deeper, check out my 3 books under the Bitcoin Fortress name, including Bitcoin Fortress, a simple guide to Bitcoin for beginners. They're written to help people understand Bitcoin clearly, calmly, and without all the nonsense. Links in the show notes to that, all the articles that we covered, as always, and the featured Substack post, if you're interested. Well, folks, that's it for episode 210 of the Bitcoin Fortress podcast. If you enjoyed the show, share it with a friend. Send it to someone who is trying to make sense of Bitcoin, macro, and the future of money. And check out the latest post on Substack. Become a subscriber. It's free. Until next time, keep your time preference low, keep stacking sats, and keep building your own Bitcoin fortress one block at a time. That's all. Bye-bye.